dear students, to the massive open online course on money and financial markets. In today's module, we are going to deal with the financial institutions. Now, we are going to have two modules of financial institutions. So today we are going to deal with the first module of financial institutions. The objective of today's module would be to understand the different types of financial institutions prevalent in the Indian economy, and also we would like to explore the DFIs or the development financial institutions in India. Now, what are financial institutions? They are basically the intermediaries who facilitate smooth functioning of the financial system by making the investors and the borrowers meet together. They mobilize the savings of the surplus units and allocate them in productive activities, promising them a better rate of return. Financial institutions also provide services to entities like the individuals, the business houses, and the government seeking advice on various issues ranging from restructuring to diversification plans. And they provide a whole range of services to the entities who want to raise funds from the markets or elsewhere. Financial institutions are sometimes also termed as financial intermediaries because they act as a middleman between the savers by accumulating their funds and borrowers by lending these funds to them. Now, financial institutions can be classified into two categories. One, the banking financial institutions, and the other is the non-banking financial institutions. Now, what are the banking financial institutions? We all know that the Reserve Bank of India is the apex body which regulates the whole banking system of the country. And the whole banking industry is subject to the control by the central bank or the RBI. So it is the apex institution which organizes, runs, supervises, regulates, and develops the monetary system and the financial system of the country. The main legislation governing the commercial banks in India is the Banking Regulation Act of 1949. And when we talk about the Indian banking sector, there also we can categorize it into two categories. One, we have the organized sector, and the other we have the unorganized sector. In the organized sector or the organized banking sector, it usually consists of the commercial banks, the cooperative banks, and the regional rural banks. The commercial banks, as we all know, are there. Along with that are the cooperative banks, which is an important segment of the organized sector of the Indian banking. The segment is represented by a group of societies registered under the acts of the states related to cooperative societies. In fact, cooperative societies may be credit societies or non-credit societies. There are different types of credit societies operating in the Indian economy. And these institutions can further be classified into two broad categories. One, we have the rural credit societies, which are basically looking after the agricultural sector. And next, we have the urban credit societies, which are primarily non-agricultural in character. Next, we do have the regional rural banks, which are set by the state government and the sponsoring commercial banks with the objective of developing the rural economy. The foreign banks are also there, which have been in India from the British days, and these banks have branches in other countries, and the main headquarters is also in their home country. After the organized sector of the banking financial institutions, we have the unorganized sector, which are mainly composed of the indigenous bankers and the money lenders. So students, my next question to you is, since I have already said that we have categorized the financial institutions into banking and non-banking institutions, what exactly do you understand by non-banking financial institutions? Now, the non-banking financial institutions again may be categorized into two broad groups. They are the organized non-banking financial institutions And we also have the unorganized non-banking financial institutions. Under the organized non-banking financial institutions, we have development financial institutions, the DFIs. These include institutions like the IDBI, the ICICI, IFCI, IICI, IRDC, etc. And they are institutions at the all India level. The state finance corporations, the SFCs, the state industrial development corporations, the SIDCs at the state level. We have agricultural development financial institutions like the NABARD or the land development banks, which are also called the LDBS, etc. And we also know that these development banks provide medium and long-term finance to the corporate and industrial sector, and they also take up promotional activities for economic development. Now, under the banner of the organized non-banking financial institutions, we also have another classified type of institutions which are called the investment institutions. These include those financial institutions which mobilize savings at the public at large through various schemes and invest these funds in corporate and government securities. They include the insurance companies like the LIC, the GIC, and also the mutual funds. We will deal at length with the insurance company and the insurance industry in India in the next module of financial institutions too. We now look into the unorganized non-banking financial institutions. These include a number of non-banking financial companies which are providing whole range of financial services. These include hire purchase consumer finance companies, leasing companies, housing finance companies, factoring companies, credit rating agencies, merchant banking companies, etc. The non-banking financial companies mobilizes the public funds and provide loanable funds. Here, as you can see in the slide, we have the organizational structure of the financial institutions. So here we have the all financial institutions in India that are there, and we have classified them into three broad categories. We have the all India financial institution, we have the state level institutions, and we have other institutions. Under the All India Financial Institutions category, we have the All India Development Banks, which are IDBI, established in 1964, the SIDBI in 1990. SIDBI is also termed as the refinancing institution for regulatory and supervisory purposes of the RBI. We have the IIBI. The IIBI is the erstwhile Industrial Reconstruction Bank of India, that is IRBI, which was established in 1985 under the IRBI Act of 1984, and then afterwards in 1997 it was renamed as the Industrial Investment Bank of India Limited, which is now known as IIBI, okay, with effect from 27th March 1997. We have the IFCI established in 1948, and again we have the IDFC, which was established in 1997. After that, under the All India Financial Institutions, we have the specialized financial institutions like the Exim Bank, the Export-Import Bank, which was established in 1988, the IVCF, which is formerly the RCTC, and it was established in 1988. The IVCF or the IFCI is a venture capital funds. And then we have the ICICI Venture and TFCI, which was established in 1989. Apart from this, we have investment institutions as I have already talked about it, that is UTI established in 1964, LIC established in 1956, GIC and its subsidiaries which were established in 1972. Apart from them, we have also the refinance institutions like the NABARD, established in 1982, the Apex Bank for rural banks, and then we have the National Housing Bank, NHB, which was established in 1980. The state level institutions are basically the SFCs, the State Finance Corporation, and the SIDCs. And in the context of the other institutions, we have the ECGC, which was established in 1957, and the DICGC, which was established in 1962. So basically, as you can see in the chart, the brackets under the respective institutions basically indicate the year of their incorporation, and the numbers that you see below SFCs, SIDCs, etc., they are basically the number of institutions in that category. So under the SFCs, I have 18, under the SIDCs, I have 28, and so on. And we need to keep this in mind also that IDBI basically became IDBI Limited on 1st of October 2004. So we can broadly now summarize the categories of financial institutions which are prevalent in India. So they can be broadly classified into three categories: the All India financial institutions, the state level financial institutions, and other institutions. And on the basis of their functions and activities, the All India financial institutions have four segments. They are the All India development banks, the specialized financial institutions, the investment institutions, and the refinance institutions. While the state level institutions comprises of the state financial corporations and the SIDCs, or the state industrial development corporations. Based on the major activity undertaken by them, the financial institutions get classified again into three broad categories. We can call them term lending institutions, whose main activity is to directly lend by way of term loans and investments. So their main function is basically lending. Hence they are called term lending institutions. We have the second category called the refinance institutions, like NABARD, the National Bank for Agriculture and Rural Development, SIDBI, the Small Industries Development Bank of India, and NHB, the National Housing Bank. These mainly extend refinance to banks as well as to other non-banking financial institutions, and hence these institutions are called refinance institutions. And then of course we have already talked about the investment institutions like the LIC, which deploy their assets largely in marketable securities. The state or the regional level institutions, they also form another distinct group of institutions. So students, I now want you to really summarize the various categories of financial institutions that are prevalent in the Indian economy at the present moment. We now come to the importance of financial institutions. As we have seen that financial institutions are the key institutions which provide fund for economic activities. There are many advantages for having a sound and healthy financial institutions in an economy. Number one, they provide funds for the investment and industrial activities. Secondly, they deal with infrastructural facilities needed for the development and promotion of lucrative ventures. These involve development of industrial estates, tech parks, road and water, bridges, etc. They are also involved in promotional activities, like they would like to mobilize the funds, reduce the risk of selling financial securities, arrangement of working and long-term capital of the business. They are also important for the development of backward areas, because financial institutions also take some social responsibilities of developing the backward areas by offering credit facilities, free education, employment creation, etc. And we can also think of them as having a hand in the planned economic development of an economy, because financial institutions basically initiate all planned developments in the view of the economic growth of the state. They play a role in accelerating industrialization because they support industries by granting finance, project development and consultancy, and thus they accelerate industrialization, which further contributes to the economic growth and the industrial growth, of course. Lastly, they have a role in employment generation because they help in channelizing the funds for investment, they help in the building of infrastructural facilities, and also in the accelerating of industries, generating employments to the educated and the qualified people of the economy. Now, after having spoken at length about the various types of financial institutions in India, I would like to pick one of them up because it's a very, very important one. So we would like at length to discuss the developing financial institutions in India. And this we will start off by understanding the history of DFIs in India. India had set up extremely successful development financial institutions like the IFCI, Industrial Finance Corporation of India in 1948, the IDBI, Industrial Development Bank of India in 1964, and of course the ICICI, Industrial Credit and Investment Corporation of India in 1955. The IFCI and the IDBI were fully owned Government of India enterprises, and the objective in setting up the institutions were to provide medium and long-term finances to the Indian industries. Till about the mid-1990s, the DFIs were very effective in channelizing such finance for industrialization of the country. Now, before I discuss further about developing financial institutions, the question that I would like to put forth in front of you is this: why do you think the role of financial institution have been under discussion in recent years? Now, the role of developing financial institutions have been under discussion in recent years because the setting up of the DFIs was an important feature in the overall development of the financial system in India. However, we find that with the emergence of the capital market as an important source of finance in the late 80s and early 90s, and the renewed role of banks in term financing, the development financial institutions in India have been increasingly exposed to a huge amount of competition. So one, we had the competition from the capital market, and secondly, there was also renewed competition from the banks themselves. After the reforms and after the phase of, and as the phase of liberalization set in the Indian economy, there was the liberalization of the financial sector, and came with it the processes of decontrol, deregulation, and globalization. And this led to increased competition for financial intermediaries across the different segments of the sector. The competitive pressures have come into the business domain of the financial institutions on account mainly because of the entry of new players into the segment. Moreover, with the initiation of the financial sector reforms in the early 90s, the access of the financial institutions to assured sources of long duration or concessional funds from the government, particularly the SLR bonds that were subscribed to by the banks and insurance companies, have been gradually phased out. So we find that the financial institutions at present are overwhelmingly dependent on market borrowings, wholesale and retail, domestic and foreign, for their resource mobilization. And as a consequence, the development financial institutions are required to raise funds from the capital market. With the removal of all sorts of administrative controls on the interest rate structure, it has become increasingly difficult for the DFIs to raise long-term funds. Apart from the competitive pressure for raising resources, the role of the DFIs as an exclusive source of development finance has diminished as other intermediaries, especially the banks, have also entered into long-term and high-risk project financing. Therefore, the financial institutions are increasingly facing competition not only in terms of raising resources but also in the deployment of funds. In short, the change in the operating environment coupled with the legacy of high non-performing assets has led to serious financial stress on the term lending financial institutions. If we try to look at the financial activities of the DFIs, we can see that the DFIs extended the term loan for setting up new units as also for expansion, modernization, and rehabilitation of the existing units. There were no sectoral restrictions except for the small negative list that was there. The DFIs could extend assistance to any industry, resulting in a well-diversified and at the same time a less risky asset portfolio. The tenure of the assistance was generally up to 10 years with an initial moratorium of up to 2 years. The mortgage charge over the fixed assets of the assisted company was provided as loan security. Defaults were insignificant and the security package was found acceptable without it being examined on the bedrock of enforcement efficacy. On top of this, we needed to understand how did the DFIs master all the resources that it had. Now, the DFIs were funded by patient equity capital and preferential market access for raising medium or long-term resources. Preferential access was in the form of channelizing the multilateral funding lines, fund flow from the National Industrial Credit long-term operations of the Reserve Bank of India, the issuance of SLR or the statutory liquidity ratio, and the tax-saving bonds, and suitable enablers to attract funds available through capital gains and investment allowance reserves. There were other special provisions made in the Income Tax Act which enabled access to the medium or long-term funds which supplemented the other fundraising avenues. So, the DFIs were also permitted to intermediate external commercial borrowing market for on-lending. And here we deal with a very, very important characteristic of the DFIs, that is their market exclusivity. It was a plain vanilla arrangement wherein the DFIs borrowed medium or long-term funds at fixed or specified interest rates from the banking or the bond market and on lent for medium-term or long-term funding. In the absence of any type of refinancing and or downselling market, the DFIs held their loan assets till maturity. The maturity profile of the asset and liability book approximated closely. The Credit Authorization Scheme, the CAS, restricted commercial banks in going for large ticket long-term lending. Access to external commercial borrowings by the corporates were not permitted. The capital market was narrow and shallow with fewer participants. The activity in the debt market was almost nil. Insurance companies and fund houses were either non-existent at that time or were yet to warm to the idea of low-cost financing of outstanding loans from DFIs to completed projects. It was a period of bliss in which the DFIs extended their medium or long-term loans to a greenfield and or brownfield projects with a good interest spread and held it long till maturity. So, we studied about all those development financial institutions that were mainly there before the liberalization phase kicked in the Indian economy. Can you people name a recently instituted DFI which is relevant or which is going to be very relevant in spite of all the challenges that it is going to face? Now, the name of that newly instituted DFI is the National Bank for Financing and Development. It is called NABFID. The bill for setting up the National Bank for Infrastructure Financing and Development has now been passed by the Lok Sabha, I think in the month of April 2022. The bill envisages setting up of a new government-owned development financial institution to facilitate the flow of long-term funds for infrastructure projects. The NABFID is likely to face challenges of intense competition from multiple players. Necessary condition for the proposed DFI to sustain will be its ability A, to retain the low cost advantage on a continuing basis, B, to withstand market competition, and C, to navigate the challenges of asset inflexibility, that is exclusively in the context of infrastructure. So we can say in the context of NABFID that DFIs, or the development financial institutions, in the past had taken steps to set up an efficient financial architecture for the country, comprising of screen-based trading and setting up of depositories and rating agencies amongst the many other functions that they performed. This had really helped to facilitate the evolution of the financial markets and had made it more transparent. And so, the success of the NABFID in imparting bond or debt market vibrancy will, be an important and a positive step in the continuation of India's endeavor in developing a vibrant, robust financial structure.